Welcome to the Microcap Brief. Let me ask you a question. What if every microcap stock you owned came with a public report card? A report card that didn't grade the company's product, but something more fundamental: its financial health, its discipline, and its commitment to being transparent. Well, that report card exists. It's called Nasdaq Compliance. And for investors in the microcap space, learning how to read it is one of the most powerful ways to protect your capital. A failing grade here can be the first and loudest warning of trouble ahead. Today, we're going to teach you how to read that report card. When a tiny company gets to list on a major exchange like the Nasdaq, it's a huge accomplishment. But it's not a lifetime membership. Nasdaq has strict rules that companies must meet not just to get listed, but to stay listed. For microcaps, which often operate on thin financial margins, clinging to these standards can be a daily struggle. And when a company fails, it's a massive red flag for you. Before we get into the rules, let's be clear on why this is non-negotiable for your research. A compliance failure isn't just paperwork. It's a signal of distress that can impact your wallet in 4 critical ways. First is the threat of the delisting death spiral. If a company gets kicked off the Nasdaq, its stock is banished to the less regulated OTC markets. When that happens, the big money vanishes, it becomes incredibly difficult to sell your shares, and the stock price almost always collapses. Second, it's a governance red flag. Nasdaq's rules require things like an independent board of directors. If a company can't meet these basic standards of good governance, it begs the question, what other problems are hiding under the hood? Third, it's a symptom of sickness. When a company is fighting to keep its stock price above the $1 mark, it's not just a sign of a bad week. It often signals deep, fundamental problems with the business itself. And fourth, it's a transparency test. When a company fails a Nasdaq rule, it must disclose it publicly. How management communicates this problem tells you everything you need to know about their character. Okay, the stakes are high. Now let's look at the report card itself. Think of it in 3 sections: the entrance exam, the ongoing grades, and what happens when you're put on probation. First, the entrance exam. To get on the Nasdaq, a microcap has to prove it has a certain level of financial substance. This includes minimums for total assets, shareholder equity, and a minimum bid price, which is typically $4 for an initial listing. They have to prove they belong in the big leagues from day one. Next, and most important for us, are the ongoing grades. Once a company is listed, the tests never stop. The most famous and most frequently failed subject is what I call the $1 GPA. A company's stock must maintain a closing bid price of at least $1. If it closes below $1 for 30 consecutive business days, the alarm bells go off and Nasdaq officially sends them a deficiency notice. This is the most common tripwire for microcaps. So what happens when a company fails a test, like dropping below that $1 GPA? This brings us to our final section: probation and the risk of expulsion. First, Nasdaq sends that deficiency notice. The company is now officially on probation. Second, the company must publicly announce this by filing a Form 8K with the SEC. This is your signal to pay attention. Third, the company gets a cure period, typically 180 calendar days, to fix the problem. To get back in compliance, the stock must close at or above $1 for at least 10 consecutive business days. This brings us to a critical question. How does a company with a 50-cent stock price get back above $1? This is where you will almost always hear the term reverse stock split. As we discussed in our last episode, a reverse split is a mechanical fix where a company reduces its number of shares to artificially boost the price per share. So how should you interpret this news? This is where your real analysis begins, because a reverse split tells one of 2 very different stories. On one hand, it can be a major red flag. When it happens in a vacuum, it's often a sign of desperation. It means management couldn't generate enough good news to lift the stock price organically. It fixes the stock price, but it doesn't fix the business. On the other hand, a reverse split can be a necessary and strategic move. It's not a red flag when it's one piece of a much larger positive story. For example, it might be required to finalize a major round of funding, or it could be part of a major corporate turnaround led by new management. The critical question you must ask is this: what else is happening? Is this a lonely, desperate act, or is it accompanied by a credible turnaround plan? The context is everything. If the company can't fix the issue in time, Nasdaq issues a delisting determination. That's the expulsion notice. The damage has already been done. So how do you use this to protect yourself? Add this two-step process to your investment checklist. Let's call it the compliance toolkit. Step 1, the 30-second check. Before you invest, go to the Nasdaq Listing Center website and search the ticker. It will tell you right there if the company is compliant or not. Step 2, the deep dive. If you see a deficiency notice, your next stop is the company's SEC filings. Look for the 8K. See what management's plan is. If they mention a reverse split, start digging for the context. Is it a sign of weakness or a strategic step towards something bigger? Let's wrap this up. The Nasdaq report card doesn't tell you if a company will be the next big thing, but it does tell you if a company is playing by the essential rules of financial discipline and transparency. Ignoring it is like ignoring a company's debt load. It's a foundational piece of risk management. A compliance failure is a warning siren. Your job is to figure out what that siren really means. Thank you for listening to the Microcap Brief. Until next time, stay sharp and do your homework.